But now let's look at some of the options. What are the options to free someone's money, Vaso?
Okay, so let's start talking about some things that we can do. Now, first, I'm going to talk about 401ks. You're basically screwed, I would say, for the most part, right? Because
Surprise.
what's interesting, I always thought that 401ks that you could not um, take an early distribution while you were still working there. But during my prep for this, I realized that is determined by the 401k plan,
Hmm.
meaning that plan could say you can't take an early distribution, but you can roll over your 401k to an IRA. Once that's done, now we don't have the restrictions that we would with a 401k. Now, so a couple of things that action items that we could do, because I know a lot of our listeners are owners of companies and that maybe they have a 401k, maybe because they wanted one themselves, or maybe their blinders are off, or a lot of times they need them for their employees because employees need them, and that's one of the benefits that they are looking for. But if you're the owner, can't you change the plan? Right, you can change the plan so you could allow your 401k to be rolled over to an IRA. But what this also means, if you do have a 401k and you transfer to another job, they're going to want you to roll that 401k balance over. I would not do that. I'd roll that over to an IRA at least. If you're not taking it out, roll it over to an IRA. That will at least give you some more options to what you can invest in, and also gives you that flexibility if you do want to take some of that money out. Now, what most people will do taking money out is a regular distribution, right? The problem is you have to wait till you're 59 and a half, right? And then that'll be at your marginal rate. Now, if we take something out early, and early means before you turn 59 and a half, there's going to be a 10% penalty, which we had talked about. Now, if you do this from a Roth IRA, what you put in, because that was after tax, you can take, so you won't pay tax when you take it out. But any gain, if there is one on your Roth, that gain will be subject to tax, as well as a 10% penalty. Now, here's a little known strategy where you can avoid that 10% penalty, and that's called substantially equal periodic payments. In essence, it means we take equal payments or withdrawals from your IRA, and you do not have to pay the penalty. Now we are going to have to pay the tax. Now, for me, I think the downside of this option is, again, it's some of the opportunity costs. We might want to move that out faster, right? But I think if you're over 50, as the closer you are to 59 and a half, the more I think that this makes sense, because we have the ability to spread out the tax as well as not paying the penalty. Now, however, doing this, you have to follow this to a T. You have to make sure that you make those equal distributions. So there is a risk there that you might not be able to follow through. So that is an option, but there is some risk. Okay, so that's kind of more of the some of the ways that, or more of the standard ways that we can take them out.
Well done. So that was amazing. Once again, Anthony, just simply amazing. Just blew me away. What are some of the strategies that someone can use to free the money from these government created plans?
Now, first, I'm going to talk about some exceptions to the 10% penalty that the IRS already allows. Now, we're still going to have to pay the tax, the income tax, but I'm focusing on the ability to avoid the 10% penalty. There's about 7 or 8 of them. Most of them, hardly anybody is really going to use, but some ones that you can, is that you can take $10,000 out of your IRA or your GCP if you're a first time home buyer. Now, one thing we need to realize, if you look at the description or definition of a first time home buyer, it's somebody who hasn't had a home. I don't know if it's 3 or 5 years.
Hmm.
Okay. So technically you might have already owned a home, but then maybe you moved and you sold it but you haven't owned a home in 5 years or during that time. You're considered a first time home buyer. Also, another strategy is maybe you got married and your spouse moved into your house, right? And then when you go to buy maybe a house together, put it in her name, and she's now a first time home buyer. I would tell you one little thing that we've done is, like, the house that we own is only under my name. It's not under my wife's name. Now, but before anybody starts making some comments here, we live in a community property state. So legally it's half hers anyways. Okay. So there is no benefit that I believe to having both of us on there. There's our advantages of only having one. And those advantages are, what if things get terrible and I lose the house, right? That's going to affect my credit, not going to affect it's not going to affect my wife's credit.
Hmm.
So, but she still owns it. But another thing that you may be able to use is you can avoid the 10% penalty if you have qualified college expenses. So that is probably the one that people can take the most advantage of. Another way would be every now and then we're going to have a lean year, right? Or maybe we're changing jobs or had a period of unemployment, or we took a large loss from investment. So that year we're temporarily in a lower tax bracket. Great opportunity to move some of that money so you can you will pay taxes on it, but we're going to be paying it at a smaller rate. And here's a little story. I have a client of mine who was flipping a house, and it just did not turn out well. All right, he's going to lose. Hopefully not, but we're anticipating that there is going to be a loss. And I said, you know what? That's a great opportunity. So you're going to be in a lower tax bracket that year. Now's the time to either take that distribution. Or full disclosure, that would be the time to roll it over into a Roth IRA. But again, there are limits of doing the Roth IRA. Now, here's a pretty cool one that I like, is you can time it so you have an investment that has tax advantages, and you buy that in the same year that you take the distribution. For example, you can buy a rental property, do a cost segregation, which means they really analyze more of the detail of the house so we can depreciate it over a shorter period of time, meaning our depreciation expense is going to be higher. And we've had some clients that were able to because of buying this rental property and using the cost segregation, they were able to take that loss. And then that was a good opportunity. What they did is they took the money from the down payment from their government created plan, and then they used that to buy the house. With this with accelerated depreciation, in some cases it was actually more than what they took out of. It was more than their down payment. Mm-hmm. So there's a way to do some timing. Now, if we buy a long-term rental, downside is, in order to take that loss, we need to be a real estate professional. But one thing that is interesting, if you have a short-term rental business, you do not need to be a real estate professional. Okay. Also, there's other investments like oil and gas. No, we haven't talked too much about oil and gas, but there's some great tax advantages of investing in oil and gas. then I got two more ways. One would be to strategically make withdrawals to make sure you're under a certain tax bracket. Because this part I think is interesting, right? If you're married filing jointly, if you make $90,000, your marginal rate is 22%. Okay. But you can go all the way up to the 24%, the top of that, 364,000. So if we think about it, you could, if you're making 100 grand, you could take out 150 grand from your IRA, and you're only going to, instead of paying 22, you're going to pay 24. Okay. And in fact, I've got a client who had recently retired, and he did really well in the stock market. He was a real investor. Like he bought the stocks, did his research, but now he's like, man, I am highly leveraged, or not leveraged, but I have a lot of money in the stock market.
Overexposed.
Yeah, he's overexposed. So what we're going to do is kind of like the opposite of a dollar cost averaging, where he's going to start slowly taking that money out on a monthly basis, and he's going to use that to pay his premiums.
Spend down.
Now, in the last method, I call it the Bo Jackson method. Just do it. Just take the whole thing out. Okay. That's actually what I personally did when I learned about IBC, but and this was in 2009. So I was fresh off the crash. So for one, the balances were had taken a nice haircut, but I used that funds to kickstart my policies.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.